All right, good evening and welcome. So we are picking this up from the paper that we were doing just a week ago. So we are doing the 2023 May-June examination, cost accounting, right? So we dealt with, this is what we did. We went as far as B, right? I think the last thing that we did was on part B. Let me just do a little recap on that. Let's see what the requirements were on that, right? So we had to calculate the budgeted fixed manufacturing overheads and allocate it. This was the manufacturing rate per direct labor clock hour. All right. And then I think I did indicate here that in some instances, you are not always going to be doing this per direct labor clock hour. So sometimes it could be machine hours, right? And then sometimes it could be units, but units are very simple. So they'll most likely not ask units at this stage. So it's either going to be direct labor clock hours or it's going to be machine hours. So we need to watch out for that. Right. And then obviously here we had to have our total of our budgeted fixed costs again, and then making use of the budgeted production. I think let me just go back to our answer sheet there, but making use of the budgeted units as well as the budgeted hours, of which we were given those hours as minutes there, we're able to come up with the total budgeted hours, and then we just divide it there. So it was basically going to be the total overheads, and then we're dividing that by, I believe we're dividing that by the hours. All right, let me see what's going on there. I think we got 0.4 something there. Okay, this is what we had there. So which was that total, 4284. I think that total must have been given there. And then, of course, that 87,000 was the total hours that was given there. All right. Now, I don't know what was going on here. I can't remember what was going on here, but I don't think we need this here. It's probably some calculations that are out of place. It's not part of our workings, I believe. All right, and then from there, all right, we came up with our over recovery, right? We came up with our over recovery, which was basically the difference between the overheads that we absorbed, right? And then the overhead that we absorbed. So it was the difference between those two there. So that can be an under recovery or an over recovery. So under what circumstances is that under what circumstances is that an over recovery? So in this instance, it was an over recovery because, as you can see, what we absorbed, the expenses that we absorbed in our trading account there, when trying to arrive or compiling expenses for our trading account, our manufacturing expenses, they were overcast. In other words, this is in simpler terms, they were overcast by 4,456. So in actual terms, we incurred much less than what we absorbed, right, into our inventories there. So hence we need to deal with that there. All right. So I promise that this we are going to deal with. I think in the next couple of questions, we are going to see how we deal with that there. But it basically comes as a line item above our gross profit, right? So what you need to watch out for, I think the simpler thing to do, something that will really not be at odds with the principle here, is to look at the principle here, right? Is to watch out, is to look at what happened here, like the way I'm explaining that we over absorbed here, so which means our expenses were more. So which means at the end of the day, this over recovery must be in addition to our gross profit at the end of the day. It must increase our gross profit. So it must either, I think the best way in which this can be put is to think of it in terms of it increasing our gross profit. So we are not going to confuse it with cost of sales, right? Though, of course, rightly, it directly affects cost of sales for the reason that it's part of the cost of inventory, the cost of goods sold that was overstated. All right, so we are moving on to part C, right? We are moving on to part C. All right, so on part number C, all right, let me just allow people in. All right, on part C, we are required to calculate the margin of safety. Right, we are required to calculate the margin of safety. So those that are joining us, they really haven't missed anything because we're just doing a recap, part A and B, what we already covered last week. So on part C now, we are dealing with the margin of safety in units per product type. Right. So this was a whopping 17 marks. This was a whopping 17 marks. So we must already realize that it was no child's play there. So we are not going to handle it with kids clubs. All right. So when dealing with questions like these, right, where you have to calculate just like A, just like B, just like C, think about the formula, right? The formula is obviously going to give you guidance. The formula is going to show you what you need to look for in the scenario, right? That's what you need to be on the lookout for there. So once you know what the formula is, then from there you go and start searching for you go there and you start searching for your data, right? You go there and you start searching for your data. So we are dealing with margin of safety. So we are gonna write down the formula there for our margin of safety. Let me go back to our Excel spreadsheet, and then we are doing part number C. Right, so please just do the calculations with me here so that you can be following as well to ensure that no one is getting lost. Right, so the margin of safety on the numerator on top there, we should have sales minus break even. Right, so let's write it as margin of safety. Right, on the numerator, when you put this in this kind of bracket, you have your sales units. So we are supposed to deduct from our sales units our break even units, and then we want to divide all of that by, because this has to be a percentage, so we want to divide all of that by our sales units. All right, so because it's a percentage, then you multiply that by 100. All right, so again, we are dealing with budgeted information, right? We are still dealing with budgeted information. But what is margin of safety anyway? The name itself basically gives you a clue. So in defining margin of safety, we first of all need to know what break-even units are, right? What we are talking about when we are talking about break-even units. So break-even units is going to be our starting point. So we'll first discuss what break-even is. So break-even point, let's start off with break-even point. Break-even point, you are at that point, if you are breaking even, you are at that point where you are neither making a profit nor a loss, right? You are neither making a profit nor a loss. So in other words, you are making zero income. So you are saying you are breaking even. So all your costs are equal to all your revenues. So we refer to that as the break-even point. That's the point, right? Where your costs are equal to your revenues. We call that the break-even point. But why is this important to us? It's important because at that point, we want to find out what the units are that you must produce and sell to get to that point. So in other words, the break-even units calculation is basically going to let you know that you need to sell X amount, to produce and sell X amount of units in order for you to neither make a profit nor loss. So which is, we basically say, in order for you to break even, right? So you are at the point where you are saying you do not want to make a loss, right? So you are just on the balance there. So we refer to that point there as the break even. So it's an important point because, you know, in terms of budgeting, we are dealing with budgeted information. You basically know that, okay, in order for this business to survive in this next financial year, we basically need to exceed the break even. In order for us to make a profit, you basically need to exceed that break even. So if your break even units, you calculate it and you get 50,000, for instance, So while you are planning in the boardroom there, you know that we basically cannot produce and sell anything less than 50,000, because it means we are running this business at a loss. So which means 50,000 is our 0 point. Then anything that we produce and sell after 50,000, this is where we start making our, that's where we start making our profits from. So that's where that is important. So it's important when it comes to decision making. It helps us in planning, right? You give people targets possibly based on these break-even calculations. You're going to tell your staff that, okay, break those targets down. Okay, the sales staff, you break the targets down and say, okay, you need to sell group A, you need to sell X number of units, group B, you need to sell X number of units. Or like what some companies do, maybe you promise them bonuses if they exceed 50,000, you see. So now that we know what break-even units are, and we say this is where you are at a point, you are at 0 profit, right? Sales units is your budgeted sales, right? It's your budgeted sales, which is usually, you are in most cases gonna be budgeting based. In most cases, it's gonna be based on your maximum capacity. You obviously wanna produce and sell as much as you can, right? So which means the difference between your sales units and your break-even units basically shows you your safety region, right? Basically gives you your safety region that, okay, we want to sell, we obviously want to sell something that is above break-even units. Then our maximum, our ceiling point there is the sales units, is the budgeted sales units. So that as a percentage basically gives you the margin of safety. That's what that gives us there. So now that we know what this is, now let's fetch the information. So when it comes to, we are dealing with this, let me just recheck on the question if it's per product or what, or units per product type. So we are basically going to be dealing with 2 products here. All right. So that's fairly easy. So in most cases, in MEC 3701 or MEC 3761, you will hardly ever deal with a situation where you are only dealing with 1 product. It's going to be multiple products, like in this case. All right, so let's see what calculations we need and what we need to fetch. So we first of all need to fetch our sales units there, right? We need to fetch our sales units. That's easy. And then this here we can put under calculation 1, right? So this is a very nice question, because now we are hitting many birds with 1 stone, right? We are gonna now learn how to calculate break even, and then how to then apply this on margin of safety. So please remember, we are dealing with budgeted information. This helps you plan as a manager, right? It helps you do your planning. So we are going to be dealing with budgeted information. So don't ever waste your time. Don't ever waste your time looking at actual information. Just deal with the budgeted. All right. So since we are dealing with the 2 products, let's just maintain this here. Right. So the easier format to use, and again, if you have a better format, it's good. It's good to come up with your own format, but make sure that your formats are understandable. Right? Just make sure that your formats are understandable. All right. So I'm gonna have sales units. We're gonna put our sales units here. We're going to fetch that information there from the question, and then from there we are gonna need our break even. So we can put our break even right here. Break even. So that we already indicated that it's going to be on calculation number 1, right? And then maybe from there you can then have margin of safety right there. So this margin of safety is basically going to be based on this calculation there, but we are just going to write it up there on Excel. All right, so Sales, let's fetch our sales. So we are looking for budgeted sales. I think we already had that on the previous question. Let's see. I think we budgeted for no, it's probably this year. I don't think we budgeted for, I don't remember us budgeting for any closing event, right? So we're just gonna, in the meantime, before I recheck, we'll just take these as they are, right? We'll just take these as they are. But let me just recheck, right? Just so we are okay. So we are going straight to budgeted information. It's on one. So, all right. So what D budgeted to produce at the annual maximum capacity for the financial year and to sell all the units produced. So that's where I'm fetching that from. So we have our sales, right? Perfect. So what do we need now? As per our formula, we then gonna need break even. So we need to do calculation for break even. So let's put that there as calculation number one. Calculation number one. All right, so break even, because we are dealing with multiple products now, our calculation is gonna get us to a break even batch. What is the break even batch? It's gonna be total fixed costs, right? Total fixed costs divided by weighted contribution. What you probably know by now is your contribution calculation, but we'll add to that and come up with weighted contribution. But still, if you don't know contribution calculation, we are just about to do that anyway, right? Now we need our total fixed cost. So here is where you need to pay attention. This is where you need to pay attention when it comes to fixed costs, because some of these fixed costs are hidden, right? Not talking about this question in particular, but in general, some of these fixed costs can be hidden. So you always need to make sure that you've got all your corners covered there. Right. So we already saw from the last question that we're doing where to start fetching our fixed costs. So they are normally going to be grouped in any case. They are normally going to be grouped. Like in this instance, we know that our fixed costs are going to be somewhere from here to right up to the end. So they normally put those last. All right. So maybe for the sake of good presentation, let me just copy this here. So we have our FMOs, which is the budgeted fixed manufacturing overheads, and we have them as this much here. Let me just copy this and paste it that side. I think what we can pretty much do here is to, all right, we have it on the sides. Let me write total fixed costs. All right, I think, right, I believe we have the right, right. What I would have ideally done in any case was to just put them all up there and then just total them up, or just put them in brackets there, just pull them together. That's still allowed. So the presentation there is up to you, right? Then we have our distribution costs, right? So these are mixed costs. So we need to be careful again of mixed costs. I think on the notes there, we talk about how to deal with mixed costs, but we will come across it again. We'll talk about it again. But I think the video covers that, right? But we will come across it, I know. Right, mixed costs, and the total distribution cost for the division is 850,000. So basic and lax budgeted variable distribution cost per unit is 2% of the selling price. Right, so it's gonna be 2% of the selling price. So the total cost is 850,000. So from this 850,000, we then have to deduct from those the variable element, the variable portion of that, which is going to be 2% of the selling price of each. All right, so let's just put that down. Let's just put that down. So we say it's going to be 850,000. Now we need to minus from there the variable cost, so which is going to be 2%. So we are minusing 2% times what? Times obviously the selling price, right? As they are saying there. But the selling price again, it has to be attached because this is in total terms. So if it's going to be in total terms, we need to be dealing with the units sold again, right? So it means it's going to be 130,000 times the selling price of basic there. Let's just have a look and see what the selling price of basic is. So which is the budgeted selling price, right? Right, the budgeted and actual selling price for basic is 65, and then the actual selling price for Lux is 67.5, which is 10% lower than the budgeted price, right? So let's start with the basic. So with basic. So basic is 65. So we come down here and we put our 65, right? So it's basically going to be 2% of this here, but not just that, because we are dealing with both our products. Then we need to deal with Lux now. So Lux is 42,000, and then we are told here on our story that it's gonna be 67.5. That's the actual, but then we are told that the actual is 10% lower than the budgeted, right? So it went low. So if we have 67.5 as the actual, and we know that the actual is lower by 10%, therefore it means we basically have to increase this by 10%, right, to get to our amount. So hence we would then multiply this by 1.1. So we are increasing this here by 10% so that it becomes the budgeted. So the actual is 67.5. We are told that the actual is 10% lower. So which means we need to increase that to make it 10% higher. All right. Understood. All right. So all this here is pretty much attached to this. So let's see if we still do have any more. If we still do have any more fixed costs. All right, let me share that. All right, there we go. All right, so we are fetching that information down there again. We are fetching that information down there again. All right. There we go. Now we have the budgeted fixed manufacturing, sorry, budgeted fixed admin, budgeted fixed admin. So anything that is fixed, we are looking for that. So let's just take that and copy it. Let's just take that and copy it there as it is. All right. Now we are doing the calculation. So this is 42,847.50 plus 850 minus 2% of, right, that is in brackets now 130,000 times 65 plus 42,000 times 67.5 times 1.1, right, and then to that 108,2280. Right. So you always want to check and see if your workings are matching, right? You always want to check and see if your workings are matching. Let me just show you how you go about that. So if you look at, for instance, your 130,000 here, it must come from somewhere, right? So you must see if your 130,000 corresponds with those cells there, and your 42,000 corresponds to those cells there. Otherwise, you are missing the principle if you're not doing that. And then, of course, the other principle there is making sure that 2% is deducted from these, from that 850,000, which is 850,000, which is your fixed cost there. All right, so we've got that. Now we can put our fixed cost there. So that's 7,183,38. So the trick with this, right? The trick with getting this right is to make sure that you are following through your working, right? You are not dropping any figures along the way. Like in this instance, you are able to trace back your 130,000, trace back your 42,000. That's the trick with getting this right. So it's not exactly about getting this amount right. We are really checking the principle. So in checking the principle, that's what they are looking for there. All right, now we need weighted contribution. Right, we need weighted contribution. So how do we get our weighted contribution? We start off now by getting our contribution per product. Right. How do we get contribution? We need selling price. What kind of selling price is the budgeted selling price? Right. So we have the selling price here. So consistency again, take the amounts that you used there. 67.5 times 1.1. So we are taking the same amounts there. You need to always make sure that your rate is consistent. Right. Sorry, I'm being interrupted here. Right. I'm in class, we'll call back. All right. Sorry about that. Sorry about that. It's just a call that was coming through. All right. They should call at 8. I think we'll be done at 8. Right. So this is selling price minus. Right. This is selling price minus our variable costs. So you want this per unit, of course. You want this per unit. We are dealing with this per unit because we want selling price per unit. So I just don't know how much space we need here, but it's fine. We will work it out. So let's just say total variable costs per unit. So we have this variable cost now, so we should remember to include this 2% here. It's very easy to forget variable costs that are non-manufacturing, right? So we need to make sure that those need to be incorporated. And so where do we get this information? So variable costs as the definition are those that vary with production. So which means all direct production costs are going to be included here. So we are going to be checking for those just now. All right, so we have 65 and then we've also incorporated this 7.5. So if you made a mistake somewhere, and it's always good to carry forward that mistake, right? It's always good to carry forward that mistake. Suppose you got your sales, your budgeted sales units wrong, just keep it consistent, right? It's always good to keep it consistent because at the end of the day, principle again calls for consistency. So you're not going to be penalized over and over again. So they are basically marking your application, right? How are you applying as you're going forward? And that's what they are checking, right? So you can't have a sales amount that is used for part A being 60,000 and then all of a sudden you come to part B, now you have 70,000. You need to be consistent. If it's budgeted sales, let it be the same. If there is a change, then it must be sanctioned where in the question. Right? It must be sanctioned in the question. All right, so the cocoa powder's budgeted purchase price was 70,000 per ton, and its actual purchase price was 72,000 per ton. So we are basically looking for what? We are basically looking for the budgeted, right? The budgeted is what we want, right? But bear in mind that we need per unit, right? So we need to incorporate that thing that we were talking about last time, that at the end of the day, since our material here, or our what's this cocoa powder is given per ton, right? We can obviously want to convert this into kilograms, right? We can want to convert this into kgs. Then once we can convert this into kgs, we want to convert those kgs into per unit. We want to see how much it's going to cost us per unit. So for starters, the starting point would be to convert this into kgs. So this is going to be 70,000 divided by 1,000. Then just to recap, let's have a look and see how much per unit we have. So cocoa powder, in terms of basic, each unit has 100 grams, right? Each unit has 100 grams. So we can also want to convert this here into kgs, right? To be uniform. All right, so we are dealing with, we say it's going to be 70,000, right? It's going to be 70,000, and then we are dealing with, again, 100 grams. So let's put that there on the Excel spreadsheet. So that is cocoa powder. All right, so first of all, we said it's 70,000, right? So that 70,000, it's 70,000 rands, I believe, but per ton. So we want the price per kg, right? We want to know how much it costs us per kg. So how do we go about that? We are going to be dividing that by 1,000 there. Then each unit has got how many kgs? So we know that each unit has got 100 grams. So 100 grams, to convert that into kgs, we are again dividing those 100 grams by 1,000. Right. So this first 1,000 here, we are reducing those tons back to where we are reducing those tons to kgs, right? Let me just read that correctly. I don't want to miss anything here. Right, so if this is 70,000 per ton, a ton is 1,000 kgs. So to take it down to per kg, we basically divide that by 1,000. So we have our 70 given there. And then we want to multiply that 70 by the number of kgs that are in 100 grams, right? So which is basically 100 divided by 1,000 again. That's basically going to give us, let's work it out, right? So because we are going to add for lakhs, I'm going to put that there. So this is going to be 70,000 divided by 1,000 times, now we are converting those grams into kgs. And then there we go. We are dividing that by, sorry, multiplying that by 100 and then dividing that by 1,000. All right, Gemina, I see you've got your hand up there.
Yes. I had a question because for the current sales volume, I used 260,000 units as opposed to 130,000 kg.
Okay,
Would that be wrong?
let me see where you are getting that. You used what? Let me just scroll up.
So from what we calculated in A, the budgeted production units, I used those values instead of 130 tons times 1,000 kg.
All right, okay, sorry, let me just go to the Excel. All right, where are we? I want to see where we are. Where are, which one are you talking about? Are we up here on the sales?
No, by total fixed costs. You see, you used minus 2% multiplied by 130,000 times 65. I used the budgeted production units that we calculated in A, which is 260,000 for basic, and then Lux is 140,000.
Oh yes, thank you for that. Thank you for that correction. This is the correct one. Yes, thank you for that. This is units, and then this is not units. This must be, what was this, by the way? The maximum capacity in terms of,
it was 130 tons. Then you multiplied it by 1,000 kgs.
yes. All right. So this one here is, yes, you are correct there. Sorry about that.
Okay. Thank
I'm
you.
happy that, yes, now I'm happy that at least you guys are paying attention. That's good. I'm happy about that. So this is it here. The number of units. There you go. 260 and 140,000. Thank you very much for that. All right. And then I was still going to touch again on this explanation here that I'm giving. Yeah. Right. Let me just, I'm gonna recheck this calculation here. It's supposed to be 1,000 there. 7. So this 70,000, by the way, I think the correct way of writing this without confusing anyone, this 70,000 is per ton. So let's just say times 1 there, which is 1 ton. But if we are converting a ton to kgs, what we need to do, we need to reduce it, right? In this instance. So we'll have to make it 70,000 times, right, 70,000 times 1, and then divided by 1,000. Then that should pretty much give us what a kg would cost. So to make it make sense, right, if you have got, we know that basically if you take 70,000 and you divide there by 1,000, it's gonna give you 70, right? So if it's 70 per kg, and then you've got 1,000 kgs, that should basically give you 70,000 there. That would basically give you 70,000. So that's the logic behind this. If we're saying this is 70,000 per ton, so how much will it be per kg? So you would expect that it's gonna be less there. And then again, 100 grams, we wanna put it in kgs also. Then you're gonna divide that 100 grams by 1,000, right? That will basically give you 0 point something kgs. So this is what you get on that there. All right, and then let's deal with cocoa powder, but for Lux now. Let's see what the story is with regards to Lux. All right, so with Lux, the quantity is instead 80 grams there. Right. The quantity is instead 80 grams, but obviously the buying price is still gonna be the same. So we are basically repeating everything that we did there, but only changing that 100. That 100 is gonna be 80 instead. Right. So we can just take this and copy it over this side, right? But instead of 100 grams, a unit here is 80. All right, a unit here is 80. So we can close off our calculation. All right, so it's gonna be 70,000 divided by 1,000 times 80 divided by 1,000. There you go. We have 560 right there. We have our 560. All right, we are still on the variable costs. Let's search again and see what we have there. All right, so we've done the cocoa powder. All right, let's see the actual full cream milk powder purchase price was was that amount 42,000 there. Right, let's just say for it full cream milk. I'm just gonna put that down there as full cream milk. All right, let's just see if there's anything said here about full cream milk. All right. Okay, so we have it for that one there, we are given at 480. So that one is not going to be an issue there, right? That one is not going to be an issue there, right? But we'll in any case do some calculations there for the other one. All right. All right, so when it comes to, I think the network on this other device here is acting up now. I think it keeps coming on and off, but it's okay. We're not gonna miss anything there. Right, but I'm back on the question anyway. I'm just back on the question. I'm just back on the question. Okay, sorry, I'm just waiting for this device to connect here. I'm just waiting for this device to connect here. All right, but in any case, if you have the question open, if you go to back on the information there on 1.1, we are, okay, there you go. I think the device is in now. I need you to watch this one carefully. No? I need you to watch this one carefully. So what we're given there on the full cream, what we are given there on the full cream is the actual price, right? We don't need the actual price, so forget the actual price. All right, let me just reshare, sorry. I'm just resharing the screen. Right. We do not need the actual price, but we need the budgeted price. So the budgeted price for the other one is given there. So we are gonna take that one as it is. All right, I'm just waiting. Can you guys see my screen there?
Yes, we can.
You can see the screen, okay. Because I couldn't see it on this side. So we are gonna take this 480 here, it's given as the price per unit, which is for lakhs. And then we're gonna use this information here to calculate for basic. That's very simple, eh? So it's 480 or 480 for this one, it's given, right? But now we need the calculation for basic, right? The calculation for basic, on the question there, we know that 480 or that 480, sorry, covers 120 grams, right? So if you take your 480 or your 4.8, rather, if you take your 4.8 there, all right, if you take your 4.8, all right, let me just put that down, 4.8 there, and then you divide that 4.8 by, I'm going back to the question, by 120 grams, and then you multiply that by, right, you multiply that by 170, which will give you the price for basic. All right, let me just explain what I'm doing there by taking us to the question there. All right, let me just explain what I'm doing there. All right, so if 120 grams basically cost you 480, we can use that information, right? We can make use of that information to basically get what, right? We can basically make use of that information to get what 170 is. All right, I'm just waiting for this screen share to change now. It's not changing quickly enough. All right, it's fine. So you are basically gonna be taking this 480 and dividing it by 120 grams. It will give you what the cost is per gram. Then you multiply that by 170, then you will get for basic. So it makes sense that the price per gram is the same for milk here, right? It cannot be different for Lux because it's the same full cream milk. Had it been different, it was gonna be put under different categories. So hence, we are making use of this one here. So please do take note of that there. All right, so let's put down the calculation. So it's 4.8 divided by 120. Then the answer we get, we multiply by 170. So that's what we get there, 480. All right, and then let's pick up again. Right, sugar price. The budgeted sugar price was 12,000 per ton. So we are still doing that per ton issue again. Right, so sugar purchase. Let's put that as sugar purchase. So it is 12,000. Right, it is 12,000, and then we're gonna go now and check how much of sugar is needed. So it's 150 and 100 there. All right, so we are pretty much repeating the same calculation as we did there on top. All right, so we said it's 12,000. So we are dividing that 12,000. All right. And then we are going to multiply that by, I believe it's 150. Right, I believe it's 150 divided by 1,000, and then now we are gonna come again. It's gonna be 12,000. Sugar is sugar. The price is the same. Divided by 1,000. I believe the other one was 100. Right. Then we are dividing that by 1,000. All right. Just to check if you're all right. So back on the question, it's 150 grams for basic, and then it's 100 grams for Lux, and then the price that we got there was 12,000 per ton. Right. It was 12,000 per ton. So it makes sense that the price per kg is gonna be slightly less, right? It's gonna be slightly less. And then how many kgs are there? Also, how many kgs of sugar are there in a unit? Then we are doing that 150 and that 150 and that other amount there, which is 100. All right, so that's the 12,000 that we're dealing with there. All right, and then, okay, let me finish up that calculation. Let's put it up there. 12,000 divided by 1,000 times 150 divided by 1,000. You have that there. Then on the other side is 12,000 divided by 1,000 times 100 divided by 1,000. So we have that there as 120 per unit, right? Let's see what else we have. Right, then to bulk up the content basic while reducing cost, they use artificial filler powders. So the actual and budgeted price per ton is 2,000. These filler powders made news, right? These filler powders made news in headlines recently for stunting children's growth. All right. So again, the actual and budgeted price is this per ton here. So this is not a fixed cost, so we need to make use of this to bulk it up, right? And while reducing cost, so we are making use of what? Artificial filler powders. So we need this again, artificial filler powders. All right, we are almost done. Don't worry, we are almost done. So this artificial filler powder per ton it's 2,000. So we are repeating the same calculation. So let's just see now what they say about them. Artificial fillers. It's 80 grams, right? So this is only used on basic. So it's 80 grams on that one. So it was actually supposed to come slightly above there, but it's still okay. It's gonna be 80 grams. So it's 2,000 per ton. So let's just do that calculation there. It's 2,000. So let's divide that 2,000 by 1,000, right? And then we are dealing with this at 80 grams, right? Divided by 1,000. So we want to know what this is going to give us per unit. So here it's 0 on this side, but here we have it 2,000 divided by 1,000 times 80 divided by 1,000. So 0.16. So that one is only applicable to basic, right? It's 0 on that one, so we leave it blank there. All right, then the purchase price for plastic containers, right? So it's per pouch, right? So both budgeted and actual were R1 each. And so let's say plastic containers. Right, so we are told again this is R1 per pouch, right? We are told again this is R1 per pouch. All right, and then attempt to curb sugar, we've dealt with sugar, and then now this is all fixed. This is all fixed, and then the only variable that we have now is this 2%. This 2% here. So this is going to be variable distribution costs. Oops. So variable distribution costs, we already noted this as 2% of selling price. So let's put that up there. So it's going to be 2% times, so the selling price is 65 for that one, and then it's 2%. The selling price for that one is 74.25. All right. I think we should just about be done with our variable costs. All right, and then here it's gonna be 0.02 times 74. All right, let's bring this up in let's box it up. Okay, so we're gonna need the total there, so which is the sum of all that there which is in the box, right? And then we need the same there, but let's make it negative. Yeah? Let's make that negative so that our workings are nice. All right, so our selling price minus our total variable cost gives us contribution per unit. This is going to give us contribution per unit there. So what's the concept of contribution now? The concept of contribution is basically about, if I'm to put it in layman's terms, we are basically talking about how much a product is contributing towards the alleviation of fixed costs. These fixed costs we are going to incur, but at the end of the day, when producing this year, this must have a contribution, must make a contribution in terms of income, must make a contribution towards the alleviation of that there. So we are basically talking about the excess of revenue over variable costs, right? Which is all variable costs again. So the big mistake that one can make here is to exclude non-manufacturing variable costs, such as the distribution costs, right? So it will be incomplete if you are not including those there. So what is weighted contribution? So weighted contribution, we are weighting this as per budgeted sales, right? We are going to weight this as per budgeted sales, so which is going to be budgeted sales. So what is our budgeted sales mix now is supposed to be based on? So you always need to watch out again here for the difference between production, right? The difference between what is produced and then again what is sold, right? So a sales mix is about what is sold, right? So in this instance, our sales are coinciding with our production, so hence it's going to be the same. But pay attention in some instances where your budgeted production is not the same as your budgeted sales. Always go for the budgeted sales. Ne? So this is supposed to be budgeted sales mix, right? So we are basically reducing the budgeted sales, the total budgeted sales to its lowest term. So it's going to be 260. The one where we got corrected on, remember, and then it's 260. Is it 160 or 140? It should be 140. Yeah, it's 260 and 140. Right. So basically, we need to reduce that to lowest term. So if you have a scientific calculator, it can be done quickly. A scientific calculator can do that quickly, but we can do so by dividing 260 by 7. Okay, no, not by 7. Let's see, what can we divide that by? Let's see. Anyone with the financial calculator, we are basically reducing 260 and 140. Let's divide that by 20. Right? Let's divide that by 20. 260 divided by 20. Yeah, that should give us 13. I don't think it can be reduced any further. Divided by 20, so that should give us 7. Okay, on that one. Okay, perfect. So this is our sales mix. So to get our weighted contribution, now you are multiplying the contribution per unit by the sales mix and then totaling those up together. All right. So this is going to be 46.94. You're multiplying by 13. And then here you do the same, 60.17, and you're multiplying that by 7. That's going to give you that. So let's say now weighted contribution. Weighted contribution should therefore be 610.22 plus 421.16. The total of those two there. So let's put it up there. 610 plus that amount. So this is the amount that we need to take now and bring over here, right, for our weighted contribution. Right, so let's 1031.38. So let's take that there. 1031.38. 1031.38. So now this is going to give us our, this is supposed to give us our break-even batch. Let's divide it there. So it's going to be 71, right? It's this amount here, right? Divided by this amount here, right? Let's just make that quick. So this is our amount there. All right. So we can obviously write this as, let me write it over here. Right. So when it obviously comes to break-even analysis, you want to round up all the time. Yeah? So this is going to be 6965. 6965. That's our calculation there. So now we need per product. Now we need this per product, right? Let me just make some space there. What am I failing to do now? All right, now we need this per product. So we have, let's take basic, let's put basic there, and then we get lux. We take lux and we put it there. So we are pretty much done with this question now. So with basic, we are basically gonna take 6965 the amount that you got there for break even per batch. We know that the batch, we need to reduce this batch now, or basically to expand on that batch. So basic has got 13 in each batch. So we need to multiply that now by 13 there. So we are going to get that for basic. So lax is 7. So it's going to be 6965. We are multiplying that by 7. All right, so we can put our answers there. 6965 times 13. And then on the other one, 6965 times 7. So now, ladies and gentlemen, these are the units that you need to sell respectively. These are the units that you need to sell respectively in order for you to avoid making a loss. All right. That's basically it. So what we basically did now today, besides rounding it all up and summing it all up, and it becomes break-even analysis, the aspect of contribution is very important. It's part of variable costing accounting or marginal costing accounting. So you'll find out that as a costing manager or as a manufacturing manager, most of what you are going to be doing to assist you in making decisions is going to be centered around your contribution calculation. So if there's anything that you really need to know how to do, is to calculate your contribution, right? So just to sum it up for you, contribution is selling price minus total variable cost. So anybody can do that. But now, what's going to distinguish you from other people is what happens here, right? Whether within the given time you are able to identify all the variable costs or not is going to be a very big determinant, right? So if you forget some, it's fine, but you always want to make sure that you put in as much as you can. So that's what we are checking there. And then are you going to deduct that to get to your contribution? We are checking that principle there, right? So ours was deducted there. And then your sales mix again. What are you doing there with your sales mix? That's what we want to see. And then you get your weighted contribution and then division. And then obviously your conclusion right there is also going to be important. So in future, we are going to be looking at some of the other uses of this marginal costing system, right? We're going to be looking at some of the uses in as far as decision making is concerned. All right. I do not know if we have any questions tonight. I do not know if we have any questions tonight before we round this up. Okay, let me stop the recording so there is privacy with your questions.